Hello, savvy investors. It's the Dividend Uncle here, guiding you through an ever-evolving market landscape. Last year, the S&P 500 soared by an impressive 24%, and as we navigate through 2024, it's already up by nearly 7%. At the heart of this surge are the Magnificent Seven: Nvidia, Apple, Microsoft, Alphabet, Amazon, Tesla, and Meta. These tech titans have not only propelled the market to new heights but have also dominated it, contributing to an estimated 75% of the market's returns. The valuation story here is telling. With the forward PE ratio of these seven giants hovering around 30, we're seeing a market that's richly valued, especially within tech. The overall market's forward PE stands at about 23, lower, yes, but hardly what one might call cheap. So, where does this leave us, especially those of us looking for sustainable investment avenues? The spotlight has been firmly on growth investing, with tech stocks leading the charge and value investing seemingly relegated to the back seat. But with current valuations, it's perhaps time to ask, is it time to revisit value investing? What's value investing, and why now? Value investing has long been heralded as a cornerstone of successful investing, championed by legends like Warren Buffett. At its core, value investing is about identifying stocks that trade for less than their intrinsic value, offering a margin of safety against market fluctuations. This approach starkly contrasts with the allure of high-flying tech stocks, whose sky-high valuations have been the talk of the town. Today, value investing's relevance is resurging. After years of growth stocks, particularly in tech, dominating the scene, the tide is beginning to turn. There's a growing belief among investors that value stocks, with their more reasonable valuations and potential for steady returns, are setting the stage for a comeback. As we navigate through a market at multiple record highs, the shift from growth to value could prove not just a safer route but a wiser, more strategic approach to building lasting wealth. In the sections that follow, we'll dive into the top value ETFs that stand out as prime candidates for your investment portfolio, providing a blend of diversification and stability amid these dynamic times. Top value ETF picks. Here are 3 top value ETFs that offer a balanced approach to investing in undervalued large-cap companies. 1. SPDR S&P 500 Value ETF, SPYV. SPYV offers investors broad exposure to the large-cap value segment of the U.S. equity market. Launched in 2000 and managed by State Street Global Advisors, it has grown to amass over $20.4 billion in assets. SPYV seeks to track the performance of the S&P 500 Value Index, focusing on companies with lower price-to-earnings and price-to-book ratios, indicative of value stocks. With an expense ratio of just 0.04% and a dividend yield of 1.69%, SPYV is a cost-effective choice for investors looking to tap into the potential of large-cap value stocks. Among the ETF's 444 holdings, the biggest include stalwarts like Berkshire Hathaway, J.P. Morgan Chase, and ExxonMobil, with no single stock weighing more than 4%. The aggregate PE ratio for the ETF stands at 19.2 times, indicating a more modest valuation compared to the broader market. 2. Vanguard Value ETF, VTV. VTV aims to track the CRSP US Large Cap Value Index, which measures the investment return of large capitalization value stocks. With an expense ratio of 0.04%, VTV stands out for its efficiency and size. Its portfolio of 350 stocks includes top holdings such as Berkshire Hathaway, United Health Group, and J.P. Morgan Chase, making it a robust option for investors seeking exposure to a diversified range of value stocks with a 2.4% dividend yield. The aggregate PE ratio is at 17.7 times. 3. Schwab Fundamental U.S. Large Company Index ETF, FNDX. FNDX stands out as a strategic choice for investors aiming to diversify their portfolios with a focus on fundamentally strong U.S. companies. Unlike a pure value ETF, FNDX employs a unique approach by tracking the Russell-Roffey U.S. Large Company Index, which selects companies based on robust fundamental measures rather than market capitalization. This methodology allows FNDX to offer a systematic, contrarian investing approach, capturing value and yield factors across a broad spectrum of industries. It has an impressive portfolio of 730 holdings and a PE ratio of 17.3 times, but has a higher expense ratio of 0.25%. Importantly, FNDX isn't confined to traditional value sectors. It includes notable tech stocks such as Apple and Meta, albeit with relatively smaller holdings of less than 4%. This inclusion ensures that investors gain exposure to the growth potential of the tech sector while maintaining a balanced, value-oriented portfolio. Performance and diversification. All three ETFs, SPIV, VTV, and FNDX, provide diversified exposure to value stocks across various sectors, reducing the risk associated with single stock investments. They have shown resilience and potential for growth, making them attractive options for those looking to diversify their portfolios away from the tech-heavy emphasis of recent years. The Dividend Uncle's take, a nuanced approach. In our journey through the elevated terrain of the U.S. stock market, highlighted by the ascent of the Magnificent Seven, the conversation around value versus growth takes center stage. This exploration began with apprehensions about the potential overvaluation in the tech sector, driven significantly by these tech behemoths. However, as we delve into the fabric of value investing, it becomes evident that outright dismissal of all tech stocks might not be the most astute strategy. This realization steers me towards the Schwab Fundamental U.S. Large Company Index ETF, FNDX, as my investment vehicle of choice. FNDX represents a sophisticated blend of diversification, inclusive of tech stalwarts like Apple and Meta, within its ambit. FNDX distinguishes itself by incorporating tech stocks that demonstrate fundamental robustness, thereby qualifying as value propositions in relation to their prices. It's a testament to the notion that not all tech is overvalued, and certain companies, with their solid financials and promising growth trajectories, warrant inclusion in a value-centric portfolio. This strategy echoes the investment philosophy of Warren Buffett, who invests and continues to hold on to Apple shares even at current prices, illustrating that even within the tech sphere, there can be stocks that epitomize value investing principles. Apple embodies every aspect of his investment criteria of a stock that has value. It's a top-tier business with a loyal customer base, stellar management, and an expansive moat safeguarding its supreme market stance from competitors. And there we have it, fellow investors, our deep dive into navigating the heights of today's market with a keen eye for value. By choosing FNDX, we embrace a strategy that balances the fundamental strengths of a diversified portfolio with the growth potential of select tech stocks, aligning with the wisdom of investing giants like Warren Buffett. Remember, the essence of value investing lies not in shunning sectors but in discerning the intrinsic worth of companies, tech included. As we move forward, let's approach our investments with both caution and curiosity, ready to uncover value in unexpected places. Thank you for joining me on this exploration. If you've found value in our discussion, don't forget to like, share, and subscribe for more insights. Here's to making informed decisions and building a portfolio that stands the test of time. Until next time, keep investing smartly and stay diversified. This is the Dividend Uncle, signing off.